Today, we will talk about financial indexes. A financial index produces a numeric score based on inputs such as a variety of asset prices. It can be used to track the performance of a group of assets in a standardized way. Indexes typically measure the performance of a basket of securities intended to replicate a certain area of the market. For example, the Standard & Poor's 500 Index or Dow Jones Industrial Average are broad-based indexes that capture the entire market, while the Russell 2000 Index tracks only small-cap stocks. Indexes are used to measure financial or economic data such as interest rates, inflation, or manufacturing output. They also serve as benchmarks against which to evaluate the performance of a portfolio's returns. Indexes are typically used to track statistical changes in security prices and are often used as benchmarks to measure the performance of mutual funds and exchange-traded funds. Indexing is a form of passive fund management, where a fund manager builds a portfolio that mirrors the securities of a particular index, such as the S&P 500 Index. Index funds are created to track the performance of an index and allow investors to bet on its performance. This approach is a popular low-cost way to replicate the returns of popular indices without actively stock picking and market timing. Prominent indexes include the S&P 500 Index, Dow Jones Industrial Average, Nasdaq 100 Index, and the Russell 2000 Index. Indexed annuities and adjustable-rate mortgages are also examples of how indexes are used outside of traditional funds. Indexes can be built in a number of ways, often with consideration to how to weight the various components of the index. The three main ways include price-weighted, equal-weighted, and market capitalization-weighted indexes. Here are 5 key takeaways. 1. An index measures the price performance of a basket of securities using a standardized metric and methodology. 2. Indexes in financial markets are often used as benchmarks to evaluate an investment's performance against. 3. Some of the most important indexes in the U.S. markets are the S&P 500 and the Dow Jones Industrial Average. 4. Passive index investing has become a popular low-cost way to replicate the returns of popular indices such as the S&P 500 Index or Dow Jones Industrial Average. 5. Benchmarking your investment strategy against the appropriate index is key to understanding a portfolio's performance. Hope this would help. Thanks for watching.